Most people think the biggest danger to the American economy has to look dramatic. They think it has to be something loud. A war, a political crisis, a technology bubble so obvious that even people who never read a balance sheet can feel it in the air. They think the biggest risk has to arrive wearing a costume. In my experience, the most dangerous problems usually arrive looking like accounting. That is why they get ignored, and that is why they become expensive. If you have spent the last year asking yourself why mortgage rates refuse to fall the way people hoped, why stocks can act perfectly fine for weeks, and then suddenly shake as if something invisible just grabbed them by the collar, why the Federal Reserve can talk about rate cuts, and yet financial conditions still feel stubbornly tight, then I would tell you to stop staring only at Washington. The story does not start there. The story starts in Tokyo, and more specifically, it starts in one of the least glamorous assets in the world, Japanese government bonds. That sounds dull enough that most people will stop listening right there. That is exactly what makes it so dangerous. The biggest risks in markets are rarely the ones with the best marketing. They are the ones buried inside structures so boring that almost nobody bothers to study them. But if you want to understand why the backbone of the global financial system may be under more pressure than people realize, you have to understand what Japan has been, what changed, and why that change reaches all the way into American stock valuations, mortgage rates, treasury demand, corporate borrowing costs, and the general cost of money itself. I do not say this to sound dramatic. I say it because the arithmetic matters a lot. And the market has a way of punishing people who ignore arithmetic simply because the subject sounds uninteresting. 30 years ago, Japan had its own glorious illusion. Asset prices soared, real estate became absurd, equities became absurd. People behaved exactly the way people always behave when money is easy and prices go up long enough. They took the recent past and promoted it into a law of nature. Then the bubble burst. That is one of the oldest sentences in finance. Then the bubble burst. After that, Japan entered a period that became famous for all the wrong reasons. The country did not disappear. It did not turn into ruin. It did something in some ways more psychologically difficult. It stagnated. No great inflation, no strong wage growth, no great vibrancy, no sustained economic lift, just a long, grinding period in which the economy seemed to keep showing up for work without ever really getting promoted. That is a strange condition for a major economy. When a country goes through decades like that, its institutions begin adapting in ways that look technical at first and become globally important later. Japan's central bank did what central banks do when they have already used the ordinary medicine and the patient still looks weak. It cut rates, then it drove them to zero, then below zero, and when even that was not enough, it did something that many ordinary people never think about, but that professionals understood very well. It put a ceiling on long-term yields. That policy became known as yield curve control. The name sounds cleaner than the act. What it meant in practice was simple. The Bank of Japan decided that long-term borrowing costs would not be allowed to rise freely, whether the market wanted higher yields or not. The government bond market was effectively told that gravity itself would now be administered. This matters because once long-term Japanese government bonds are pinned near the floor for years and years, domestic investors face a miserable arithmetic problem. Imagine you run a Japanese insurance company, or a pension fund, or a large bank. You have billions to allocate. You need return. You have obligations to meet. You have liabilities that still exist, even though the local bond market has been turned into a museum of tiny yields. If your home country's sovereign debt pays almost nothing, then you do not have many satisfying options. You can accept almost no return and slowly suffocate, or you can go looking for yield somewhere else. That second instinct changed the world. Japan became one of the largest exporters of capital on earth, one of the largest foreign holders of United States Treasuries, one of the major buyers of mortgage-backed securities, one of the major stabilizers of global fixed income. And the point that people miss is that Japan did not do this because it wanted to support America out of friendship. Capital rarely moves because of affection. Capital moves because the math tells it to move. That is the only love story worth studying in financial markets. The math told Japanese institutions that if home was paying nothing, the rest of the world looked very attractive. And once that logic had been in place long enough, an entire global structure grew around it. The easiest way to explain that structure is through what became known as the yen carry trade. The name sounds exotic. The mechanics are not borrow cheaply in yen. Convert the yen into dollars or some other currency. Buy something with a higher yield, collect the spread. That is the whole idea. When your funding cost is close to zero, almost everything yielding meaningfully above zero starts looking interesting. Treasuries, corporate debt, mortgage-backed securities, emerging market positions, technology stocks, real estate exposures, anything with pulse and yield begins attracting money. People always imagine major financial structures must be complicated. Many of them are embarrassingly simple at the core. The carry trade was one of those simple things that became enormous because the conditions supporting it lasted so long. A person borrowing yen near zero and buying something yielding 4% could produce a beautiful spread if the currency relationship behaved and the cost of hedging remained manageable. Do that once, and it sounds like a clever trade. Do that across a vast institutional system for decades, and it becomes part of the plumbing of global finance. That is what happened. The world grew used to Japanese money flowing outward. It was not just a flow. It was a quiet stabilizer, a background buyer, a consistent absorber of debt, a source of liquidity that made a great many other prices possible. People like to talk about global finance as if everything revolves around central bank speeches in Washington. That is too narrow. The system has always depended on foreign demand, funding structures, carry incentives, and pools of capital moving according to yield differences across countries. Japan sat at the center of that story for much longer than most ordinary investors understand. The reason it mattered so much is that price, insensitive or nearly price, insensitive demand can hold up an entire market structure. If a large buyer keeps showing up year after year because the alternatives at home are still worse, then the market benefiting from that demand begins to treat it as background weather, permanent, dependable. Part of the scenery, that is how danger usually develops. A system becomes fragile when it stops recognizing its own assumptions as assumptions. It begins treating them as architecture. That is exactly what happened with Japan. The world got used to near zero Japanese rates. It got used to the idea that borrowing in yen would remain cheap. It got used to the idea that Japanese buyers would keep reaching outward for higher yields. It got used to the idea that the long end of the American Treasury market would keep enjoying this support. Then one day the assumption broke. And when an old assumption breaks after supporting a major structure for 30 years, the public almost never understands the consequences quickly enough. That is where we are now. Japan changed. The Bank of Japan ended yield curve control. Then it raised rates. Then it raised them again. That was not just a local policy adjustment. That was a message to the whole world that one of the easiest funding environments on earth was no longer eternal. The effect was immediate, because when the Japanese rate structure changes, two parts of the old trade stop looking so easy. First, borrowing in yen becomes more expensive. Second, hedging the currency risk becomes more expensive. Now look at that, from the perspective of a rational allocator. The old trade depended on a generous spread between what you paid to fund yourself and what you could earn somewhere else. If the funding cost rises and the hedging cost rises, the spread shrinks. Once the spread shrinks enough, the old free lunch feeling disappears. That is a very important shift. Financial structures can persist for a long time while they feel like easy math. They become unstable once they stop feeling like easy math. And markets do not wait for the last participant to admit that the easy math is gone. They start moving the moment enough participants realize the old incentive is deteriorating. That is why markets reacted so sharply after Japan's policy shift. This was not simply traders being emotional. It was a recognition, however, imperfect, that a major source of cheap global liquidity was no longer as cheap as it used to be. And when the cheapest major source of global liquidity gets less generous, everything that depended on that generosity has to be repriced. That is the key. The issue is not merely that Japan made a local policy move. The issue is that the world had built an enormous amount of positioning, valuation, and comfort on top of the idea that Japan would keep exporting capital because Japan had nowhere better to put it. Now Japan may have somewhere better to put more of it. At minimum, the comparison is changing. And once the comparison changes, you get something the public rarely thinks about until it is underway. Repatriation, money going home. That sounds harmless. It can be anything but harmless. For years, outward Japanese capital supported global markets. If even a modest portion of that flow slows, reverses, or becomes more selective, then the pressure does not remain isolated to some academic corner of international finance. It moves straight into the markets, most reliant on steady demand for long-duration paper. That brings us directly to the United States Treasury market. The ordinary person hears Treasury yields and instantly falls asleep inside. I understand the impulse. I do not share it. The bond market is not a side story, it is the backbone. And the long end of that market matters more than most people realize. The Federal Reserve controls short-term policy rates, that much everybody says. But the 10-year, 20-year, and 30-year parts of the curve do not simply obey the Federal Reserve because the chairman spoke clearly at a press conference. Those yields are driven to a large degree by supply and demand, and supply is not exactly tiny right now. The United States is issuing debt on a massive scale. Trillion-dollar deficits are no longer unusual. They are normal. The Treasury must finance current spending, refinance old borrowing, and keep the whole machine supplied with fresh paper. That means somebody has to buy. A lot for a long time. Japan was one of the quiet answers to that question. Now imagine what happens if one of the most reliable foreign support pillars becomes less eager at the margin. The first mistake people make is assuming nothing changes unless the buyer disappears completely. That is not how markets work. A small shift at the margin matters enormously when supply is already heavy. If a huge debt issuer must keep coming to market with more paper, and one class of historically strong buyers is no longer as enthusiastic or no longer finds the trade as appealing, yields have to do more of the work. That means higher long-term yields than many people expected. That means the long end can stay elevated even if the Federal Reserve cuts short rates. This is the point that confuses so many people. They think Fed cuts automatically mean easier financial conditions everywhere. That is not necessarily true. If the short end goes down but the long end stays sticky because Treasury supply is enormous and marginal demand has weakened, then plenty of borrowing costs remain tight in the parts of the economy that matter most for households and valuations. This is exactly why people feel confused. The headlines say the Fed is getting easier. Their mortgage quote does not feel easier. Stocks remain unstable. Credit still feels expensive. Businesses still do not behave as if money is free. That is not contradiction. That is the yield curve telling the truth the headlines are smoothing over. A steepening yield curve in this context is not a harmless technical curiosity. It is a message. It says the front end may be easing while the long end remains under pressure from supply, weak demand, inflation concern, and fiscal reality. That matters because the long end is the price of time in a great many markets. Take stocks. People love to talk about earnings as if earnings alone determine valuations. That is incomplete. A stock is a claim on future cash flows, and the further out those cash flows sit, the more sensitive their present value is to long-term discount rates. When long-term yields remain elevated, the amount investors are willing to pay for future earnings changes. That is not emotional whim. It is arithmetic. A higher long-term yield means future cash gets discounted harder. Valuation multiples compress. A company can report respectable numbers and still see its stock trade worse because the rate environment changed the price the market is willing to pay for those numbers. That is why a bond story becomes an equity story so quickly. It does not require collapsing earnings. It requires a higher long-term hurdle rate. And when the market is full of assets priced for a world where capital would stay generous and future cash flows would always receive premium treatment, the shift can feel sudden. People say the market freaked out for no reason. There was a reason. The denominator changed. That is not a side issue. It is the issue. The same logic flows directly into housing. Mortgage rates are not pinned to the overnight federal funds rate, the way popular discussion suggests. They are closely linked to long-duration yields, especially the 10-year Treasury. If the 10-year does not come down meaningfully, mortgage rates do not magically float back to the world people grew used to in the previous easy money era. That means affordability stays strained, refinancing activity stays muted, home turnover stays weak, construction math remains difficult, and the housing market stays in the same painful zone where prices remain elevated relative to incomes while financing costs remain hostile to a normal buyer. That is why so many people are still waiting for the housing market to feel better and remain confused when it does not happen. They were told rates would fall once the Fed softened, but if long rates remain pinned higher by supply and weaker foreign demand, then the easing they expected never really reaches them in full. Again, the issue is not whether the Fed moved. The issue is which rates matter for the real economy and why those rates may not follow the comforting script. Now, expand the lens again. Corporate credit. When money was extremely cheap, companies borrowed with joy. Acquisitions got easier. Private equity math worked more cleanly. Refinancing did not feel threatening. Buybacks flourished. Risk appetite spread. Cheap debt acted like a tailwind across the whole corporate world. Now imagine a world where the overnight rate can be nudged lower, but the longer end remains more stubborn than expected because the bond market is dealing with heavy Treasury supply and less generous foreign demand. That is not a world of restored abundance. That is a world where the price of long-term money stays higher than many business models, investors, and households hoped. In that world, capital allocation becomes more selective. Weak companies feel it first, speculative ventures feel it next, highly leveraged structures feel it after that. And because credit is the bloodstream of the corporate system, the consequences do not remain trapped in bond desks. They show up everywhere. Slower deal flow, more demanding lenders, more conservative underwriting, lower valuation multiples, a weaker appetite for marginal projects, stricter hurdle rates, longer dry spells in sectors that became addicted to easy capital. This is why I keep saying the real story is not one rate cut. The real story is the cost of money at the long end of the system. That cost is shaped by supply and demand. And Japan has been a much more important part of that demand story than the average person understands. If Japan had remained frozen forever, perhaps the old system could have limped on longer, but it did not. The old duct tape is peeling. That is how I think about it. Japan was never the whole system, but it was a great deal of the tape holding together assumptions about global liquidity, foreign demand, relative yields, and the idea that someone would always show up to absorb enough American debt at tolerable prices. What happens if that someone becomes less enthusiastic, not disappears entirely, just becomes less generous? That is enough. Markets are set at the margin, treasuries are set at the margin, mortgage rates are set at the margin, valuation multiples are set at the margin, credit spreads are felt at the margin, and the margin is exactly where the Japanese story matters most. I have always found it amusing that the financial media spends so much time on the visible, theatrical, emotionally engaging stories, and so little time on the plumbing. People want to hear about inflation because inflation is easy to dramatize. They want to hear about artificial intelligence because it feels new and exciting. They want to hear about politicians because politics flatters tribal emotion. Those things matter in their own way. But markets often break or tighten or reprices around plumbing far more than around drama. The plumbing is what keeps the whole structure liquid. And when liquidity changes, almost everything else gets repriced, whether the public understands the underlying cause or not. That is why this subject matters so much. The biggest risks are often the ones that feel too boring to deserve attention. A person cannot build a serious understanding of markets if he only studies what makes headlines. He has to study what makes rates. And rates, especially long-term rates, are not set by speeches alone. They are set by who must sell and who is still willing to buy. That is where the Japan story becomes so important. For 30 years, one of the greatest hidden gifts to the American financial system was that Japan's domestic conditions kept pushing capital outward into treasuries, outward into mortgage paper, outward into global asset markets, outward into the carry trade, outward into the sort of liquidity support that most Americans never noticed because they did not need to notice it. They only needed the benefits. Now, some of those benefits are being reconsidered because the math that created them is changing, and math is a much more serious force than narrative. Narrative can keep people calm for a while. Math eventually wins. There is another piece of this that I think people miss. A changing Japan does not just affect the Treasury market through direct holdings. It also affects psychology. If one of the world's most persistent low-yield funding sources changes, the entire mental model of global liquidity changes with it. That affects how investors position, how they hedge, how they think about duration, how they think about risk, how they think about what normal financing conditions really are. For years, normal became distorted. Normal meant zero in Japan. Normal meant endless support for carry structures. Normal meant foreign capital helping absorb American debt. Normal meant valuation frameworks built on the quiet assumption that long rates would not need to do much of the work. That normal is less normal. Now, whenever a system loses a familiar support, there is a phase where the public keeps using the old map and keeps being surprised that the road no longer leads where it used to. That is where we are. And I do not say that with pleasure. I say it because investors, homeowners, business operators, and anybody trying to understand the cost of capital in the next decade need to stop pretending the answer sits only in Washington. The Federal Reserve matters. Of course it matters. But it is not God. It does not dictate the long end of the Treasury market by command. It does not eliminate the need for buyers. It does not erase deficits. It does not make Japanese capital ignore improving yields at home. And it does not force the rest of the world to finance American borrowing on comfortable terms forever. That is the illusion I think people need to give up. the idea that someone, somewhere, will always show up to buy the debt. Keep long rates calm. Keep mortgage rates manageable. Keep valuations rich. And make the whole system feel easier than the arithmetic really deserves. Systems built on that assumption are not strong. They are merely accustomed. And accustomed systems can behave very badly when one of their oldest supports begins to weaken. If I had to reduce the whole matter to one sentence, I would say it this way. The real risk to the American economy is not always the loud story at the center of public conversation. Sometimes it is the quiet withdrawal of a buyer that made the whole cost of money machine feel easier for 30 years than it had any right to feel. That is what Japan represents, a quiet withdrawal, or even the possibility of one. And because so much of modern finance has been built on the comfort of abundant liquidity and easy foreign absorption of debt, even a moderate change in that comfort can have consequences far beyond the bond market. That is why mortgage rates matter. That is why corporate credit matters. That is why equity multiples matter. That is why every conversation about easy financial conditions should begin with a much harder question than people usually ask. Who is buying the long end? Not who is speaking. Who is buying? That is the backbone. And if the backbone gets weaker, then the whole organism moves differently. I do not know the exact timing of every move ahead. Nobody honest does. What I do know is that the world's largest economies do not spend years depending on a foreign source of cheap capital and then adjust gracefully when that source starts changing. Adjustment is usually awkward, sometimes disorderly, often underappreciated at first. That is where I think we are now. Not at the final chapter. At the chapter where the old assumptions are becoming less trustworthy, while the public still speaks as if the old assumptions are permanent. That gap between the story people tell and the arithmetic underneath it is where major financial mispricings live. It is also where smart observers need to spend more of their time. So if you want to understand what might really tighten financial conditions in America, do not stare only at the Fed. Do not stare only at politics. Do not stare only at the latest market obsession. Look at Tokyo. Look at Japanese yields. Look at the yen carry trade. Look at the long end of the Treasury curve. Look at the demand that held the machine together. Then ask the only question that really matters. What happens when the cheapest, steadiest source of global liquidity for 30 years is no longer quite so cheap and no longer quite so steady? That is the question I would be asking, and it is a much more serious question than most people realize.